my name is Jo and I'm part of the marketing team here at Netwealth. Thanks for joining us today for our Practice Management webinar. This is our series designed to help wealth professionals discover new opportunities to enhance their business. We're delighted to have Andy Sowerby, the Managing Director of Legg Australia and New Zealand, join us today to share the key results for Australian advisors from their Global Investor Survey. Before we do so, we'll run through some housekeeping. There is one CPD point allocated for attending this webinar. To receive this CPD point, you'll need to have watched for at least 30 minutes. The CPD will then be emailed to you within the next week. This webinar is being recorded and you'll receive a copy of the session along with the slides in the CPD email. If there's anything you'd like to ask Andy, you can do so via the question tab in the toolbar to the right of your screen. A little bit about Netwealth. For those who don't know us, we're an ASX-listed company nearing our 20th year, and our online platform supports financial advisors with a wide range of financial products and services to help manage their clients' investments and superannuation. Key features include a market-leading advisor and client portal, a mobile app to help you and your clients access key information on the go, a wide range of investment options, and a suite of detailed reports that can be tailored to your client and business needs, and access to unique insights developed to help your business grow. Now on to our speaker. I have the pleasure of introducing Andy Sowerby. He was appointed to his role as Managing Director in Legg in August 2016. He moved to assume this role from Legg global equity specialist Martin Currie Investment Management. Andy had joined the Martin Currie team in 2005 and was appointed to the executive and the main board in the same year. There he was responsible for global sales, marketing and client services. On to you, Andy.
Thank you, Jo. Good lunchtime, everyone, I should probably say. Good afternoon. It's a great pleasure to be here on this Netwealth webinar and this series that I know that they bring out to financial advisors on a regular basis. So our agenda today is to talk to you about the Legg Global Investment Survey and to share with you some of the observations and findings from that survey that we think are pertinent and helpful to you and how you do your business with your clients going forward. So if I can just step into what our agenda is for today, I'm very briefly just going to give you a line or two on Legg The meat of this presentation is to discuss our survey, so I'll talk about the methodology of the survey and then from there bring out key themes that are pertinent to Australian investors. I'll contrast that globally with other markets and then give some key takeaways and thoughts at the end. There is room for questions, as Jo's mentioned, as we go throughout, and we'll try and capture all of those questions at the end, time allowing. Okay, quick introduction to Legg Many of you will know us, some of you will not. A few facts. We're quite a unique beast in the marketplace. We are a company that owns 9 independent asset management firms, and those asset management firms are specialists in their own asset classes. So they focus on one thing and one thing only, and that is investment excellence. And Legg as a parent is a holding company, and we do the product structuring and distribution for them. As an organisation, we are truly active, big believers in active management and the value that can add over time. We manage about $1 trillion Australian across those 9 groups. And in Australia, we have today actually our funds under management in Australia are up to about 57 billion Australian dollars. And as you can see at the bottom, we've been awarded the Fund Manager of the Year for the last 2 years from the Lancet Money Management Awards. So enough about us, just move straight into the Global Investment Survey and the overview of what we do. So a couple of points. I think surveys and statistics in general, the broader, the deeper and the more consistent you can be, the more valuable they are. So this is a global survey. I'll get into some of the data points, but we do this every year. This is our 6th year of conducting the survey, and the respondents that we target are investors who are active, who are actually investing money or intend to invest money and have been moving around in their portfolios in the previous 5 years. There are 17,000 respondents to the survey, 1,000 of which are Australian, and we are able to compare and contrast the cohorts on different metrics, and I'll give you some examples of that as we go through. The last point there, that's actually the link to the full survey. So the full survey is available on our website. It's a must-read. It's about 100 pages of information, and you can go in there and you can look at it on a collective basis or indeed on a country-by-country basis. And we share that with the marketplace because we think it adds value generally, but we use that information quite heavily in our own business as we consider things like product development, training and education, content and content delivery that we need to deliver to the marketplace. And I think on that basis it's helpful for us as an organisation. So just a few of the kind of data points. So as I said, it's our 6th annual survey. It's conducted by an independent group who do that for us. We design it with them, but they do the research on the ground. There's just short of 17,000 respondents. It's basically 1,000 per country that we target. And the last survey we did was in the third quarter of last year, so July to August of last year. We actually started publishing the findings from about December last year. If we look just from an Australian perspective, what this slide shows is just the profile of the respondents. And I think the first thing you can see here is it's broad. It's broad by age, by gender, by family type, by the work status of the individual, be they working or retired. We can separate by income and income levels, and we capture information such as the assets that they would hold in their portfolio. And of course, all of this data is then things that we can drill into as we consider the learnings and the findings from these different cohorts. So the main body of this presentation is to share with you the key themes that came out of the Australia part of the survey, and then to bring some contrast with the other parts of the world. There's 7 key themes that we're going to address as I go through this. And I'm going to start off talking about advised versus DIY or do-it-yourself investors. And the overriding statement I would make before I go into some of this detail is advice matters and advice is valuable. And we'll see that as we go through some of these data points, that's based on both the actual outcomes and experiences that investors have received, but also in an emotional sense to do with the confidence, security and indeed happiness of advised investors versus DIY investors. So I think that's quite helpful. Secondly, we have post this call, we will make available to you a piece that we've pulled together just to contrast the advised versus non-advised investors, and it basically under the title of How Advice Has a Positive Impact on Outcomes. So statistically proving the value of advice in the people that were surveyed through this process. So a few points. So first of all, how many use advisors? So 45% of respondents in the survey use an advisor for the majority or all of their decisions, and 17% are using an advisor sometimes. So a reasonably big part of the survey respondents use an advisor. The second one is quite an interesting point for us. Kind of surprised us a little bit, if I'm honest, that millennials love advisors. We were surprised to see such a high percentage of the millennial cohort using advisors for most or all of their investment decisions. And as you can see, it's twice as high as for the baby boomer cohort. So interesting to see that the younger population coming through and valuing advice and indeed relying on advice. The next point is a self-assess test. So do you see yourself as an expert or an advanced investor? And here you can see that advised investors believe they have more knowledge than a DIY investor. And the second point that comes out in this sub-bullet is an advised investor tends to see volatility as a positive, not as a negative. So I think that goes to this idea of buy the dips. If you see volatility in markets, that can create opportunity, and that's an opportunity that you should look to exploit, particularly when valuations may move away from fair value and create opportunity to invest. So I think that idea of an advised investor being more assured and more positive in a volatile environment is a strong endorsement of advice. And that really parlays into the next point. Advised investors are more confident about the future, and they're more confident about the future of the next 12 months, and they're more confident in their ability to have enough money for a comfortable retirement. And I suspect that's pointing to sensible long-term financial plans, agreed goals and objectives, and reporting back against those goals and objectives over time. Another thing which I'll come to in a bit more detail is the asset allocation is very different, advised versus non-advised. As I'll show later, advised investors tend to have much more balanced, diversified portfolios than the DIY investor. And that's particularly true if you look at areas such as fixed income. You'll find for DIY investors, they tend to have much less and often nothing in fixed income assets in comparison to an advised investor who we would observe have a much more balanced portfolio. This slide just shows you some of that data on a chart format from a knowledge difference. This is a point I made about being self-assessed. So advised investors tend to see themselves as having more expert or advanced knowledge. This is a portfolio asset allocation. Again, this is Australian only. We're not contrasting on a global basis at this point. But you can see for an advised investor, more balance across their portfolio, more investment in alternatives, more investment in fixed income, less in property. DIY investors tend to be more biased in that direction. Both cohorts hold quite a lot in cash, and I'll come back to that later on in the presentation. Some other observations on advised versus DIY investors. So for an advised investor on an income portfolio, they tended to generate higher income returns than DIY investors. In the ESG space, so this is environment, social and governance, this is really thinking about funds which embrace those factors in the way that they are managed. Advised investors tend to be more versed in this subject and bigger users of these types of products. And again, I'll come back to that in a little bit more detail. Global exposure is much higher for advised investors than it is for DIY investors. And separately, I'm sure that many people on this call will look at some of the statistics around self-managed super funds that would support that observation that comes back, or these facts that come back from our survey. We tend to see more DIY investors being more dominated by local assets than global assets. But that also points to product development. One of the things that we think about as an organization is how do we make some of our global capabilities more accessible, and that, for example, would include us developing ETFs to put on the ASX to make them more accessible. And then in retirement, I've slightly touched on this point already, but advised investors feel more confident, and also they tend to have a plan about retirement. So they will have a view about how will they move from a pre into post-retirement environment, whereas DIY investors tend to not really have a strategy around that and tend to be more static in terms of their portfolio management through that important period. Investor confidence. So here, a couple of points, I think. First of all, investors were very confident when we did the survey, and I'll show some graphs to support that. The younger generation, the millennials, are very confident. They might be very confident about everything, but again, there's a few observations when I get to that I'll share about why we feel that might be the case. Again, this point about advised versus DIY. Advised investors are more confident than those who are unadvised. And that goes back to my opening statement around feeling more confident and more secure about the long-term planning, because they have that trusted voice that they can rely on. Volatility, friend or foe, I think this is an important point. People see volatility as an opportunity in general. And if you then marry that with the high cash balances that we can see in the asset allocation, I think that creates an opportunity for advisors and for asset managers in periods of volatility to help investors continue to broaden their investment strategies. People are positive on equities and going forward. If you think of when the survey was taken, which was in the third quarter of last year, that was ahead of the market correction that obviously happened through the fourth quarter. You always get in these surveys recency bias, and that we would always observe that. And indeed, I said we've been doing this survey for the last 6 years. We've also been pretty much in an uninterrupted bull market over that period of time. But it is something that we are cognizant of. But there was a more positive outlook this year than we had seen previously. And then the most common investor concerns, I think no real surprises. Volatility, obviously, but interest rates falling is a truism around the world. And as you can tell from my accent and indeed Joe's kind introduction, I'm not from these shores. I come from an environment where interest rates have basically been zero for a long period of time, or close to. They've risen a little bit more recently. And clearly in Australia, we've seen interest rates coming down and probably continuing on that trajectory going forward. So we're in a low interest rate, low growth environment. And I think that those low interest rates necessitate the need for more diversification in portfolios, probably thinking about that cash balance, and again, relying on advice to help on that journey. The next slide is my point on confidence. You just sum together the blue and the orange bars to see if people are very or quite confident, and you can see this across the different cohorts that we've just shown here. To my point on millennials, you can see that over 80% of the millennial respondents were either quite or very confident. Our view on that is twofold. One is they've had a very strong market for the last 10 years, so they won't remember instances like the GFC, or indeed going back a bit further, the tech wreck or the Asian financial crisis, or for those of us with longer memories, we can go back to many other market corrections. So they haven't really had to deal with that. So again, a little bit behaviourally, you would say that they've got that. They haven't had that bad experience that many of us have lived through in different cycles we've lived through. So that would be one. Secondly, they've got more time on their side. So I think that to itself would probably point to a more confident investor. They've got more time to repair damage as and when it happens. But each cohort was actually pretty positive on a look forward basis over the next 12-month period. And then the thing about the volatility equals opportunity, and here, I reference back just to my point on cash balances. The average cash balance for a DIY investor was 34%, just over, and the average cash balance for an advised investor was 25%, just over. Those cash balances give some firepower, particularly if we see some kind of correction in markets, where investors might look to take advantage of that with a long-term mindset. And this chart just reinforces my point on equities seem to be strong and positive for the following 12 months. And indeed, they're right so far. We'll see if that continues to be the case at the end of the 12-month period. Okay, I'll move on now to asset allocation. This is our sort of third area that we focused on from the Australian respondents. So number one, not only are investors saying they're more positive on the outlook for equities, they actually increased their allocation by 7 percentage points compared to the previous year. So the confidence was there and the activity was there. And that equity allocation was funded by a reduction in both property and cash. And I suspect the cash reduction continues to be in response to the lowering returns from that asset class. Yeah, and I think the last point I may pick off on this slide is the millennial point, having a more non-traditional asset allocation. We'll show some data to support this, but the millennials tend to be very, very different in the way that they think about investing and the way that they construct portfolios. And so this next slide just contrasts 2017 to 2018, and you can see some of the points that I've already referenced. This is where the portfolios have been positioned. So a little bit of an increase in alternatives, a reduction in a general sense in property. Fixed income's been reasonably flat, but a big move towards equities over the course of that 12-month period for 2017 to 2018, and that being funded partly by cash and partly by property, as I said already. So interesting to see where allocations have sat, probably not too dissimilar in some of the asset allocation models that you will be running for your clients as you build up their portfolio exposure. To my point on millennials, this is millennials doing it differently, but here we can see that the millennials have a much bigger weighting to alternatives and precious metals, which is a smaller subset of that, than we see for the other cohorts, and very different to the baby boomers. I think baby boomers have typically got more standardized sort of 60-40 type portfolios or 70-30, more equity and bond in nature. But we see that there's a much more of a sort of open mindset in the way that the asset allocation is being put together for the millennial investor. And the other side of that is they don't have enough equities, and arguably they don't have enough equities in their portfolio to meet the growth requirements that they need. And actually one of the things that we observe in the millennial typical portfolio construction is their confidence is high about their future, but the way they've structured their portfolios may not meet the requirements they will have from a return context to meet their goals, because they're probably too underweight in certain growth assets. So something that we think is quite interesting from an education point of view. Okay, so I'm going to move on to theme number 4 now, which is around income. And income is also a very hot topic for a couple of reasons. Demography, obviously more investors moving towards retirement, the baby boomers into that phase now, and the requirement to have income producing assets is obviously a key topic. Secondly, is more pertinent for this country and very true right now, is the whole debate around franking credits and where that goes to post the federal election in a week or so's time. With those kind of opening remarks, most investors in Australia have income producing assets, and those income producing assets are biased heavily towards dividend paying shares, and I suspect that's not a surprise to people on this call. What we do see through the data is advised investors have much more diversification in their overall portfolio, but also in their income producing assets, and DIY investors using fixed income more significantly in portfolios, where DIY investors are much more concentrated on shares, and we suspect, and some of the SMSF data would support this, on a few large cap shares that they hold on the exchange. What is also interesting is, this is quite a good point, I think, to kind of just pause on a little bit, is the income growth. So what this does is we ask what people's income expectations are, and then what they are receiving from their investments. And there's a couple of things. So first of all, income expectations have come down 2017 to 2018. So they've dropped from 8.3% per annum to 8.1% per annum. That's still too high. It's very difficult to generate an income close to that overall without taking a significant amount of risk in a portfolio. Investors recognise they're getting less than what they are trying to get. That gap has narrowed somewhat, but clearly franking credits would be part of that equation for many of those investors. But we can see that the actual income being produced for investors, this is their own assessment of it, of course, is 7.2 versus that 8.1 expectation. So a narrowing of a gap, but we certainly feel as an organisation there's an insatiable demand for quality income solutions, and it's something that we continue to innovate on and develop and deliver good product to market, we hope. And this just picks out some of the data graphically. So here we can see the composition of income producing assets for the DIY investor versus the advised investor. Just reinforces what I've already said. The advised investor much more diversified, much more balanced, and the DIY investor much more concentrated, particularly into dividend paying shares. Okay, so theme number 5 is ESG. And I would say this is one of the big stories that came out of this year's survey for us. We see significantly more demand for strategies that embrace environment, social and governance factors in their investment decision-making process. And this is already something that is very strong across the institutional market segment in Australia, and it's definitely had that sort of drip down effect into a more wholesale retail perspective. But I think investors themselves are becoming more interested and more educated. So number one, we say there's more demand than we have seen. Secondly, there are higher expectations placed on all of us, frankly, in the value chain, but certainly on investment managers to act appropriately as a steward of their clients' capital. So to take on board these factors in our decision-making process. We would also note from the survey there is a really deep thirst for knowledge. People are interested in this, but they don't necessarily understand it. And we see that as in our own business as being somewhere we want to continue to develop insight and education to help. A final comment on ESG is a little bit like one man's meat is another man's poison. It's not homogeneous. And clearly, from a product point of view, what we need to make sure is we're designing products which satisfy the vast majority of people's requirements, but that we are very explicit in our disclosure about what we do and what we don't do, recognizing this is really about individual values. So a big area, something that we as a firm are very focused on, and you can expect in the industry, from an industry perspective, to see a lot of product development and news flow around this as we go forward. You can also see it in the different generations of cohorts. This is very, very high up the millennial wish list. So as these millennials become wealthier, as they inherit capital, you can, and I'm sure you already are, seeing a lot of discussion and debate around this matter with your clients as you go forward, as we are at Legg Mason. This next slide says environment and governance dominate social. I actually, when I re-looked at this again last night, it's actually really balanced. What I would say about social is I think people struggle to measure it and to put their arms around it. I think it's easier environmental factors and governance factors to really understand and put your arms around that. But when you get into social, which is more around labour practices and the like, there's a lack of quality data. But we are, and as are many of our competitors, working with our investee companies to ensure that we get better, higher quality data to help us make more informed decisions around these areas. Okay, theme number 6 is technology. And Australia came out slightly differently to the rest of the world here, and I'll contrast that in a minute. But the overriding message from here is this is a people business. And when it comes to money matters, people want face-to-face advice in Australia, and they want the human touch. They absolutely expect technology to be there to help in that process, but there's no replication for a human touch in the advice process. that is consistent with what we're seeing actually on the ground in the marketplace. And if you look at the next slide, this contrasts Australia to a more global context. The last 2 points really speak to people matter, and particularly from an Australian viewpoint. So nervousness if there wasn't a human available to talk to about managing my investments. 70% of respondents, remembering this is 1,000 in Australia. And personal touch service with the human touch can never be replaced with technology. A 75% response rate. So very, very strong in the view that this is a human process. However, we should embrace technology and we should look to deliver solutions using technology. And also we're all used to the way that we bank using our apps and our phones. I think we're going to continue to see developments in that area. And indeed, I'm sure Netwealth are very much at the forefront of many of these discussions with many people on this phone. Okay, number 7 in our themes for Australia, and it's around the millennial cohort. So more optimistic than the other cohorts. I've shown you that. As I said already, I think that's really down to they have more time. They have enjoyed nothing really apart from a bull market in their investing lives, unless they started very, very young. They see themselves as more knowledgeable about investment, arguably overconfident. They're more likely to use an advisor, which I've already said was a surprise to us, but we think is encouraging. And they are much more open to investing in new asset classes. So they actually have a twice the weighting to alternatives in comparison to the baby boomer. I've already mentioned they are very concerned and engaged in ESG, and they are more tech savvy and more willing to embrace technology in helping them manage their investments. And what this slide shows is we've just taken 2 of those cohorts, and one of the things you can do with the data sets is you can make these comparisons across different cohorts in different countries. But this shows millennials versus baby boomers. And you can see on a line-by-line basis here, where are the differences. So expert advanced investment knowledge, you can see the millennial believes they are more than twice as expert as their baby boomer comparison. You can see the ESG point, free from the bottom. They are more likely, 70% likely to be looking at ESG considerations in their investment decision making. They would like to understand how their money is being deployed to help build a better, more sustainable future, and the engagement there is high. So just some interesting comparisons as you think about different cohorts and different clients that you serve. What does their typical average member of that cohort tend to think around these different subjects? So that's a very high level walk through 7 of those big themes that we've pulled out of the survey from an Australian perspective. Just a couple of other things that we wanted to pick up. Some of these came from some of the questions. And when we put the survey together, there are standard questions for all 17 markets. That we also put in some particular questions for each individual country that we think are relevant, and we just picked out a few different things here that we thought were important. So the first one, I feel I've sort of touched on most of these points. I would just maybe the last point there, if you're advised, you're more likely to be investing on a global basis and have more diversification than if you're a non-advised client, and probably not a surprise there. The second point, quite interesting, is the whole positioning around fixed income in Australia. It is no surprise that fixed income here is less owned than it is in other developed markets around the world. I'd contrast it with the US or the UK or other European markets, or indeed Japan. And the reason is you've had such high cash rates for so long, it wasn't really serving a role in your portfolio in many ways. That's obviously changed and is changing. We see fixed income as under-owned. It's broadly misunderstood, particularly when you get to the direct investor, and it's probably needed more than ever. So certainly from our organisation, we're really trying to increase the training, the education and the content to continue to expand people's knowledge of that asset class. The third one here, which is about which investments do you expect to plan to when you retire. I've made the point already that it tends to be advised investors have a plan, a strategy, and have an idea of where they are going to, whereas DIY investors tend to not really have that and are more likely to leave their portfolio actually completely unchanged through that transition into retirement. The last point we asked was around exchange traded funds or ETFs, and what was really interesting here from our perspective is many people think ETFs are about price, and that's certainly not been our view of it. To us, it's an access vehicle to access a capability, and ETFs do not equal passive, particularly in this market. So absolutely, passive investing is about price. But as you will all realise, there is a growing group of active exchange-traded funds available on the ASX. And what people are really interested there is, well, how's performance been? Can I get the information that I need? Do I understand it? And indeed, does my advisor recommend it? And interestingly on ETFs, again, I think many people think that they're not necessarily used as much in the advice segment as they are directly, but indeed it's the opposite is the case. You're more likely to use an ETF if you have got an advisor than if you do not have an advisor. That was certainly our expectation, and that was confirmed through the survey. A few comparisons on Australia versus global themes. So you're more likely to be advised in Australia than you are if you're in another part of the world. It's 45% versus 43%, so it's reasonably close. But we have more DIY investors in Australia than we do elsewhere in the world too. So we have more unadvised investors in our market than we see elsewhere. And indeed, if you contrast that to the US, it's quite a marked difference. Higher investment knowledge, self-assessed for Australians versus other investors around the world. So Australians are generally just more confident, and I'll pull that slide up in a minute. But there's a lot more confidence in this country around investing and the outlook for investment markets. The last point is an interesting one as well, is more Australian investors, when asked, are they focused on investing for retirement or are they focused on investing for a more comfortable life pre-retirement and more short term, the Australians were less focused on the long-term retirement portfolios than they were on the shorter term portfolios and goals that they have. And one of the things that we take from that is we think this is to do with the compulsory pension system. I think there's a sort of sense that superannuation and compulsory savings will provide for me in my retirement so I can think more about my short-term needs. And it was just an interesting comparison to other parts of the world which obviously don't benefit from the super guarantee. And this just tells you that this is just the data to back up that Australians generally are in the more confident cohort. I can't really comment on Mexico. It's interesting that they seem to be the most confident, but they do. But there's a high degree of confidence in the Australian marketplace in terms of the outlook for investing markets and also for retirement needs and long-term goals. Just a few last themes I just wanted to pick out before we start taking some questions. Australians generate more income. I've talked about franking credits. I've talked about higher cash rates. And you can see the contrasts on a global basis on average and if you look at Europe as an example, how much lower that is. I've mentioned already that Australians are more tentative about technology, that they truly value the human touch. It's not something that comes out in this survey, but we've done elsewhere. The human touch becomes more valuable the more money you have, frankly. So as assets build, the need for good quality face-to-face human advice grows, and the confidence and the support of an advisor becomes more significantly valued. However, people also want to have the ability to have an efficient technology platform. So ideally, they would like to run all of their finances through the same app. And certainly we are seeing greater aggregation around technology to enable that to happen. And then I've touched on this point, this low exposure to fixed income. It actually went down 2018 versus 2017. So we've actually seen a slight reduction in fixed income allocations over those two periods, and it remains low on a global context versus the average portfolio, be that on a global basis, or we've picked out the US numbers there so you can see them. Okay, so just to sum up from me, a few points. Investors' views are maturing. They're quite confident about the future. Importantly, on average, and by quite a margin, they see volatility as a positive, not as a negative. That certainly we felt was an encouraging thing. Portfolios have shifted towards equities. There's always a risk. That's a recency bias-driven decision, but we've seen that both in terms of the words and the sentiment, but also the actions in portfolio construction. Millennials are different. I think we know that. I'm not a millennial, but I know a few, and they are different. But they definitely look at the world through a different lens, and there are some trends coming up there, particularly around ESG, particularly around alternatives and investments, and particularly around technology that we continue to watch and monitor as an organisation. Very, very strong message I hope you take from this call is advice is very valuable and has a real important part in the psyche of an investor. It helps them. They have more balance in their portfolios. They have a clearer strategy. They are more confident. They are more assured, and you can actually conclude they are happier about where they are going. And as I said, we've pulled together a flyer which summarises that simply down at the 4 pages, and we'll make sure that gets sent out to you from the team at Netwealth after the call. And then ESG is rapidly gaining progress. I said this was one of the big trends that came out of this year's survey. Very fast change in sentiment, interest, and that's something that we will continue to be, as an organisation, focused on in the way that we communicate with you, our clients, so you can support your clients. Finally, we have a strong range of funds. They're all available on Netwealth. I'm not going to bore you with what they all are, but we have strength across equity markets, fixed income markets, and multi-asset solutions, and we're a proud partner of the Netwealth Group, and you can get in touch with us or them if any of these are of interest to you, and that's our sales team. Contact details are on the slides, and maybe I'll stop there, Joe, and pass back to you if that's okay.
Perfect. Thanks, Andy. Some really interesting insights there, particularly on millennials. Very interesting for me, especially. We'll go to some questions now. I've got a couple so far. This one, Ian was just trying to confirm the average value of holdings was 36,000. I'm not sure which slide that was on, but he's wondering if it skews any of the numbers shown.
Yeah, I'm not. Hi, Ian. I'm not quite sure where the 36,000. Yeah. What we targeted were people who will be investing at least 15,000 Australian dollars in the next 12 months, and who have made changes to their portfolios within the last 5 years. So they were the two things that you had to have done to qualify for the survey. There was not a requirement on a minimum balance, to my knowledge. If that is different, we will confirm that afterwards. But the two tests we had were the two tests that I mentioned.
Cool. Thanks, Andy. I've got another one here from Daryl. If Australians are receiving 7.2% per annum for their income assets, is that because of the higher yields from Australian shares and bank stocks in particular, and the receipt of franking credits?
Yeah, so that's a great question, and I think the answer to that, if I could answer it in one word, would be yes. I think if you look at the overall portfolio compositions, you can see a reasonably or a strong bias to local shares, particularly in the DIY portfolios. So a big reliance on the higher yielding equities available in the market and taking advantage of those franking credits. So certainly we see those income expectations and realised income trending downwards. So both the expectation and the actuals trending downwards. And one of the things that we focus on as an organisation is delivering products which are income, where their primary objective is income. So products which are designed to deliver you high, sustainable and growing income to help offset some of those trends that we have in a lower interest rate, lower yielding environment, and particularly if we do see some of these franking credit benefits start to disappear.
Thank you. We've got another one here. I'm not sure if it's a question. How do you view the underlying entities in the ethical income fund?
Oh, okay. So that's more of a particular. Okay, so more of a particular question. So Martin Currie is one of our investment subsidiaries. They'll be known to many of you. They have a very strong presence in Australia, managing portfolios of Australian equities, and a big presence offshore where they run global equities and global emerging market equities in particular. Within that range of products that they have an ethical strategy, and that ethical strategy has a number of processes around that to remove certain sectors and certain stocks. To the person that's asked the question, if there's anything in particular you would like to know about the underlying securities, the selection process, if you get in touch with one of the salespeople on the bottom of the sheet, Tony Pattison is sitting beside me and he's nodding. He'll very happily pick that up and answer any particular questions that you have. But what we've done with those strategies is, so people are really clear, is we blended together a positive process around looking for those companies which embrace ESG and sustainability as an organisation, but we've also put in place a negative screen which removes certain sectors and certain companies based on certain characteristics. As I said in my kind of main presentation, there's a little bit about this is one man's meat is another man's poison. So we recognise that there may be some things in the portfolios that don't meet everybody's definition of what is ethical. But what we do is two things. One is we are absolutely transparent on our investment process and why we choose the stocks that we choose. And secondly, we get the RIAA, which is the Responsible Investment Association of Australia, to do an independent accreditation of the fund to make sure that they are true to label so investors can have that confidence. And that's a completely independent process of us. So they're the things that we do to give people comfort. But obviously, you know, it's a very particular thing, ethical investing, and I'll probably let that question now flow through to our team and we can answer it independently.
Great. He said he's going to contact Tony, so thank you for that.
Great. Thank you. Thank you for the question.
I just might wait another minute to see if anyone has any other questions. Otherwise, wrap up.
Great.
We might wrap up there. Then.
Okay, well, I'll maybe just finish. So, first of all, I know time is valuable, so I appreciate everybody who's joined this call. I hope it's been interesting. I hope it's been helpful. A couple of things. If you go to our website, if you are interested, you can go and you can get a copy of the full survey. And I will be, and as will my colleagues, very happy to pick up on any questions, either in person, by telephone, or on email that people may have afterwards. So please ask us. Secondly, I hope the 7 themes were interesting to you. As I said, we have taken the advice component and really tried to take that data and generate that into effectively a short sales aid, which I hope will be helpful to you as you talk to clients and just remind them about the value of the service that you deliver. And thirdly, this is an annual survey. So as we go along and as we update the survey in this year and in future years, we will continue to make that available. And it's really the longer term trends and the comparisons through the cohorts which add value over time it does inform our business. It really does. We think about it from a product development point of view, from an education point of view, and a training point of view. So if there's anything that's come out that you would like more on, we're absolutely delighted to help you. And I'll maybe just finish by saying thank you once again for your time.
Thank you, Andy. Again, we've had a lot of thank yous come through, and it was a great presentation. Thanks everyone for listening. I hope you found it really valuable. As a reminder, your CPD point will be emailed to you within the week. We'll also include a copy of today's recording with the slides. And finally, in case you're interested, we have another CPD webinar coming up on the 21st of May, and Aberdeen will share how to identify quality Australian small cap stocks. Thank you.